Okay, what's up everyone? This is going to be the first video for chapter 2. We are looking at the accounting process, right? From soup to nuts, kind of how does it work from beginning to end, what we do each period in the accounting cycle, journal entries, all that kind of good stuff, right? As a starting point, remember we have the kind of four financial statements, right? We have the balance sheet, which is prepared at a point in time. It's your assets equal your liabilities plus your stockholders' equity. We have the income statement, which is prepared for a period of time, right? Your revenues minus your expenses. We'll build upon that in this chapter, looking at comprehensive income and then a whole other chapter on that. We have the statement of cash flows, right, which is your beginning cash flows. Or I'm sorry, your beginning cash plus or minus your operating, investing, or financing activities gives you your ending cash. And then we have the statement of owner's equity or shareholders' equity, which has kind of two equations, right? The common stock equation, the beginning plus what you issued minus what you repurchased gets you your ending. And then your retained earnings, which is your beginning retained earnings plus your net income or minus the net loss, minus your dividends, gets you your ending retained earnings, right? So that's kind of where we started at last chapter. We're going to build off of this, right? And all of this should be review with journal entries, right? And kind of just like a cheat sheet here before we get started, right? We have our assets equal our liabilities plus our stockholders' equity, that fundamental accounting equation, right? If we were to conduct transaction analysis and do these journal entries, right, the debits are always going to be on the left, credits always on the right, debits on the left, credits on the right. It's plus, minus, minus, plus. In other words, you increase an asset with a debit, you decrease it with a credit. The reverse is true for liabilities and stockholders' equity. So that's going to be our little cheat sheet. The other kind of pointer to remember is, as a general rule, you are going to debit your expenses and credit your revenues. We'll talk about why you do that. And then let's also just talk a little bit about some trick accounts, right? Accounts receivable, right? If you see the word receivable, that's an asset. Compare that with a payable, right? Whether it's a note payable or account payable, that's a liability. Other things you can see, right? Maybe prepaids on there. It may say prepaid expense or prepaid asset. That's the same thing, right? The trick with it is, even though it says the word expense, it's actually an asset. And then unearned revenue, which you may see, or deferred revenue, even though it says the word revenue in it, is actually a liability. The only other one that comes to the top of my head is cost of goods sold, right? COGS, that is an expense. So if you know the four financial statements, kind of the little baby equations that go with them, this guy right here, plus, minus, minus, plus, debits on the left, credits on the right. Generally, you debit expenses, you credit revenues. And then the trick accounts, this is going to take you a long way in this class, right? I'm trying to get you up to snuff where you need to be. Some of this, is going to be a repeat you've seen before. Some of it's a little bit hazy, and a little bit of this chapter is going to be new at the end. But that's what we're talking about here, right? This chapter, we're going to start with kind of transaction analysis, right? We are trying to record economic events, internal and external, to the business, right? So, for example, an external event might be like we buy a truck, right, for the business, debit truck, credit cash. An internal event in distinction would be something like we used supplies during the period, right? Debit supplies expense, credit supplies. It didn't involve any kind of external party on there. We have this fundamental accounting equation, right? Your assets equal your liabilities plus stockholders' equity. If we build it out a little bit further, right, that stockholders' equity has kind of the two babies in it, right? Common stock and retained earnings. One of the things we mentioned, right, is you're generally going to debit expenses and you're going to credit revenue, right? It's one thing to memorize this, it's another to understand why we're doing what we're doing. If we talk about revenue, right, if you increase a revenue, right, you increase net income. If you increase net income, you increase retained earnings. If you increase retained earnings, you increase stockholders' equity. The upshot of all of this, right? If stockholders' equity is minus plus, you're generally going to credit a revenue, right? Because doing that ultimately increases stockholders' equity. It's a big kind of nesting, Russian nesting doll there. We have to think about the logic chain of all this ties out. But you credit revenues because they ultimately increase stockholders' equity. Expenses do the opposite, right? They ultimately reduce stockholders' equity because they make your net income go down. Same kind of framework for gains and losses. On their dividends reduce your retained earnings, right? That's why you're generally going to debit dividends, because if you follow the logic chain up, it reduces retained earnings, which reduces stockholders' equity. Overall, right, we're talking about a double entry system, right? Debits and credits. Our total debits always have to equal our total credits in every journal entry. And when we say debit and credits, it's no more difficult than just thinking left and right of the T account, which are like every account we use: cash, truck, receivable, payable, right? It's going to have its own T account. And then the general ledger on there, right, that's going to act as kind of a cumulative, right? All the T accounts, all the balances will track on there. Some of this is going to sound kind of theoretical until we roll up our sleeves and look at it. So just hang in there on it. But we said, hey, debits are always on the left. So if you see DR, that just means debit. Credits are always on the right. Debit on the left, credit on the right. That is always true. Okay. When we do a journal entry, right, our total debits, right, so it'd be like DR, 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 depending how many counts, right, always have to equal our total credit. So if we had $100 in, total debits and there were 2 credits, right, if this one was 75, then that one has to be 25 to make our total credits 100 equal the total debits. Talked a little bit about this framework on there. Now we're going to get into the accounting cycle, right? It's kind of like the Lion King, the circle of life. We have our own circle of life in accounting. Every month it repeats. They, collapse all of these up here into this and that, right? I like to start with just right here, right? Step 1 in all of this is going to be the general journal, right? Step 2 will be the general ledger. We'll do an unadjusted trial balance. We'll make adjustments to it, AJEs, which will allow us to then make an adjusted trial balance. We'll prepare the financial statements. We'll close out the temporary income statement accounts, right? We'll do the reverse for our revenues and expenses to get rid of them. And then ultimately, we will prepare a post closing trial balance. So through this, right, we're going to do 3 trial balances: an unadjusted, an adjusted, and then a post closing trial balance. Let's start with, right, they go through here, right, you can read through this, about those steps, but let's start with just the general journal, right? So kind of step 1 is the general journal, right? I always remember J comes before L, right? So the general journal is first, then the general ledger is second. What will happen, right? We have source documents or information from the client. They give us a bunch of things that happen, right? Like A, B, C, D, right? All of those. And we have to record them as they happen, right? Chronologically. So, hey, we received cash for stock, right? So we'd have to do debit, cash, credit, stock. We would then carry that over, right? All of the T accounts, right? So if this was like debit, cash, credit, common stock, in that case, right, $60,000, right? 60 and 60, we'd have to find the cash T account and the common stock T account over in the general ledger over here, and we post it over, right? So it would be like debit to cash 60, credit to common stock 60. One of the things when we look at that general ledger to be aware of, If it's an asset account, right? So for example, cash, which is an asset, namely a balance sheet account. Remember, assets, it's plus, minus, debit on the left always, credit on the right always. But wherever the natural balance is, the plus, that is where the beginning and ending balances are going to be, right? So it's normally beginning plus additions minus subtractions get you your ending. If it were a liability account or a stockholder's equity, right? So like account payable liability, that would be minus plus, right? Wherever the plus is, oh, sorry, I'm going crazy here with this. That is where the beginning balance would be our additions, our subtractions, and then our ending balance. Each of them has their own thing, right? So it would be like beginning cash plus what we got plus minus what we spent gets us our ending. So, the A and the S and the E, they all mean different things for each account. But when we look at that, we have to keep it straight. Okay, so we're starting at step 1, the general journal. They will give us a series of information, A, B, C, D, all of these guys. We got to do the journal entries, and then we carry it over to step 2, the general ledger. So let's just do some practice journal entries, right? This should be, definitely review. So we, issued stock for cash, right? So always think of, what did, the way I like to do these is identify, classify, and then I like to just say like play the game, right? We have to play the game where our assets equal our liabilities and our stockholders' equity, where we can use that cheat sheet. We'll do this for the first 2, but I'm not going to do it for everyone because this is, intermediate accounting. It's not like baby level accounting. But just to get us refreshed, right? We have 2 investors who gave us $30,000, right? So there's $60,000, and there was common stock in play, right? So we essentially got cash and we gave up some equity, right? Those are the 2 accounts in play, cash and common stock we've identified. Cash, common stock, we now have to classify, right? Cash is an asset, common stock is a stockholder's equity account. Then we have to play the game, use that cheat sheet, right? Cash, right? Remember we said assets equal liabilities plus stockholders' equity, right? Plus, minus, minus, plus. After this transaction, do we have more cash or less cash, right? Well, we have more cash, so that's going to be a debit to cash. After this transaction, right, do we have more stockholders' equity, more common stock, or less common stock, right? Well, we have more. We increased our common stock, so we'll credit it, right? So debit cash, 60, credit common stock, 60. Our total debits equal our total credits. Let's look at 2, right? We borrowed $40,000 from the bank. We signed a note payable, right? What did we get? What did we give for step 1, right? Cash and notes payable. What is that, right? That's an asset and a payable is a liability. After this, do we have more cash or less cash, right? Well, we have more cash. After this, do we have more notes payable or less notes payable, right? We have a liability that went up. It's like we charged our credit card. Asset plus, if we play the game, that's a debit. Liability plus, if we play the game, that's a credit. Our total debits equal our total credits. All right, we're going to go a little faster on this because, again, this is intermediate. We paid $24,000 in advance for rent, right? That would be debit prepaid rent, that asset account, right? Remember I said prepaid expense, things we pay in advance are an asset, and we paid cash for that, right? So we have asset plus, asset minus 24. We purchased office equipment for $12,000 cash. This is about as simple as it gets, right? One kind of trick or tip for you is always start with cash, right? Cash in, cash out, debit, credit. It's about as easy as it gets. If we know our total debits have to equal our total credits, right? If you know that this was $12,000 credit to cash, then you could plug office equipment for $12,000 to make it balance. But doing the plug, right, presupposes you have the rest of it correct. That one's pretty easy there. How about we bought inventory on account, right? We told the person we bought it from, we will pay you later, right? So we have an asset plus we have a liability plus, our total debits equal our total credits. Be aware there's a difference between a perpetual kind of live inventory system versus a periodic inventory system where we only account for things generally at the end of the period. We'll talk more about that in the inventory chapters. All right, bought supplies for cash, right? We got supplies, we gave cash, asset plus, asset minus, total debits equal our total credits. Here's one you do have to be aware of, right? Whenever we sell our inventory, right, as a general rule, that's going to give rise to 2 journal entries, right? In this case, right, looks like we sold our inventory for 35 and it cost us 20. Journal entry 1 is to record the revenue from the sale, and that's based off the sales price, right? So debit cash, credit sales revenue. Journal entry 2 is to record cost of goods sold, right? When we buy the inventory, we don't immediately expense it, right? We wait until we sell the inventory to expense it as cost of goods sold. This is based off of whatever we paid for the inventory or whatever it costs us to make, okay? So that's an iteration where the person pays us, we sell stuff for cash. Same thing here, except the person who we sell it to says we'll pay you later. We now have a receivable from them. So you can look at that. How about this one, right? We are now renting out space, right? And the tenant paid to us money in advance, right? We have some unearned revenue, right? They paid us in advance. We're sitting on cash that isn't ours. That's a liability. We will tee this up. As we earn the revenue, right, we will flip out that liability, but when we get it up front, we have to record it as a liability. Next up, right, we paid off some of the account payable we owed, right? Liability minus, right? It's like if you pay off your credit card balance, it goes down the amount you owe. Obviously, our cash went down, okay? How about this? Salaries for the first half we paid, right? We said generally you're going to debit expenses. We have credit cash there. That's great. And then it looks like, hey, we collected on some of our accounts receivable, right? We sold stuff to them. They said, we'll pay you later. Now they're paying us later. Debit cash, credit account receivable. Last one here is we declare, and it looks like we pay a dividend, right? So dividends reduce stockholders' equity, right? So this is stockholders' equity minus. That's why we're debiting it. The cash, obviously, is the outflow there. You can look at these, right? If you incur a salary expense, you would do debit salary expense. If you issue stock, right, it would be debit cash, credit common stock. But for each one of those, right, A, B, C, D, right, each time we did one of those, so we kind of went through A, B, C, D. For every one, right, if that was the equivalent of the X where we did it, we then have to post that journal entry, right, whatever we debited and credited to the appropriate T accounts, right? So for this one, right, we did debit prepaid rent, 24 credit cash. You can see we take it down on there. For each of those, you would do the posting. And again, remember, if it's an asset account, the beginning balance is going to be here. We have our additions, our subtractions, and our ending balance. If it is a liability account or a stockholders' equity account, it will be, right, so here's accounts payable. It'll be the beginning over here, additions, subtractions, get you the ending, okay? Because it's the reverse, plus minus, minus plus. What we then do, and this is just continuing with that, right? We have done the general journal, right, where we do all of them as they happen. We've done the general ledger where we populated all the T accounts, right? Now what we're going to do is whatever these ending balances are in the T accounts, right, we're going to take those and put them into a giant T account, right? So we have all of these T accounts over here with the ending balances. We will put them in a giant T account and make sure that our total debits equal our total credits, right? So that's what we're doing here. And this is going to be our unadjusted trial balance. Okay, so we carry that over. We carry this over. We carry this over. Total debits equal total credits. We'll have our assets, our liabilities, our stockholders' equity, our revenues, and expenses. That's great. This is where we are right now at the end of the period. Everything is, perfect and great, but this is an unadjusted trial balance. What we now need to do is take some of these accounts, right, and bring them up to their proper balances in light of the fact that, hey, maybe we earned some revenue, we incurred some expense related to these. So that's what this guy is saying right here, right? We need to do our AJEs, our adjusting journal entries, and these really come in two different flavors, right? We have our prepayments, which I like to just call it our deferreds, and we have our accruals. What's the difference between these, right? When we have our deferreds, right, I like to think of this like we defer on it. We pass until later, right? We have recognition later. It's like my little cousin when I'm like, hey, Connor, do you want to read a book? He's like, later. That's just a nice way of saying no. We will have the cash first, but the recognition later, right? So if it was a deferred expense, for example, we would spend the money first, but we would only take the expense later. If it was a deferred revenue, we would get the money first, but we would only recognize the revenue later. The accrueds, right, are the reverse, right? We will have recognition first, but we will have the cash later. So it could be an accrued revenue where we'll recognize the revenue in this period, but we'll only get the money for it next. It could be an accrued expense where we would recognize the expense in this period, but we'll only pay it next period. This will make more sense with examples, right? So this is what they're saying, right? It's cash before recognition on there. So some of these you can go through, but here's an example of a prepaid expense, right? The cost of acquired in one period and expensed in another. If we check this out, right, they tell us, right? So this is a prepaid expense, which is going to be an example of a deferred expense, right? During the period, right, what we did was we bought insurance, right? We paid the money for that insurance. Now, here we are at the end of the period, right? We had money first. Now we're going to have the expense second, right? The expense comes later. You could plug it into a T account, right? We started with 0. We bought 2,000, and at the end of the period, we had 1,200. We're talking about supplies, right? So I said prepaid expense, but it's a supply as an example of that. You could have prepaid insurance. So if you do 0 plus 2,000 minus X, right? If this is your X equals 1,200, then hey, we must have used $800 of supplies on there. Another could be prepaid rent, right? During the period, right? One of those X's we made, right? We gave the landlord, the person we are renting from, money in advance, right? So we, in that case, gave them the money. Here we are at the end of the period. We have to accrue some of the expense, right, for that. So in this case, right at the beginning of July, right, that X, we paid $24,000 in advance, cash out. Now some time has passed. We have to take the actual expense, debit, rent expense, credit, prepaid rent. We teed up the prepaid. Now we get rid of it commensurate with how much we have used on there, right? So there's one example of a deferred expense for supplies. There's another example for prepaid rent. You could also have it for things like long-lived assets, right? Another deferred expense. Maybe we bought, one of those journal entries we did was we bought a machine, right? So that was what we did during the period. Now we're at the end of the period. We have to accrue, right? So we spent the money for the machine first, but now we're at the end of the period. We have to recognize the expense for that machine, which we're going to use depreciation on there. So you can look at the calculation, but essentially it's debit, depreciation expense, credit, accumulated depreciation, right? So those are our deferred expenses. So money first, expense later. Wait, what might be another one? Hey, you buy airplane tickets in advance and then you use them later. On there, the idea is you spend the money first, but here we are at the end of the period and we have to account for the expense. Deferred revenues, in distinction, right? We're going to get the money first, but we're only going to recognize the revenue later, right? It's second on there. So let's look at some examples here, right? During the period, right? One of the little X's we did the journal entry for. We rented out space to someone else, right? They gave us the money originally, and we did that unearned rent revenue on there, that liability. Now, here we are at the end of the period, right? We have earned some of that revenue because time has passed. We're going to have to flip out the unearned and credit the revenue commensurate with what we've earned, okay? You can look at that MCQ. How about accrued expenses, right? So we talked about deferred expenses. We talked about deferred revenues. With accrueds, right, we're going to have the recognition first, right? There's going to be some type of expense first, but then we're only going to pay the money later on. So let's look at an example here, right? Looks like during the period, right, our employees worked, right? They worked during the period. We have to accrue for the fact, right, take the expense at the end of the period for that work. However, we're only going to pay them next period, right? So we have expense first and then money second on the accrued expense. So you would do debit salaries expense, credit salaries payable. Ultimately, when you pay them next period, you would flip out that payable. How about accrued interest, right? Another thing that could happen is during the period, right? Maybe we borrowed some money, right? That's one of those X's that's on there. What you then do, right? You have to pay, you may ultimately owe the money here, right? In like next period, but because this is an accrued expense, right? We got the money up here, which we borrowed, but we'll have the expense here, and then we'll ultimately pay it on there. So we're going to have the recognition first and then the cash outflow second, okay? So when we calculate interest expense, right, because we borrowed the money here, now some time has passed, it's going to be the principal times the stated rate, generally times the number of months that have passed over 12, right? This interest rate is based on an annual amount, so we got to keep things apples to apples if you're wondering why we're putting that over 12. Ultimately, debit interest expense, credit interest payable. Okay, you can look at that. How about an accrued revenue, right? If it's an accrued, right? Remember we said we'll have revenue first, and we'll only get the money later. Let's look at an example here, right? We loaned a company some money here, right? So one of those transactions we did, we lent somebody money. They're ultimately going to pay us next period, right? But we have to accrue the revenue that we earned during the period. So revenue first, we'll only get the inflow later. It must have been $30,000 we lent them. There was an 8% rate. 1 month has passed, right? Over 12 months, because that's an annual amount. We will do debit interest receivable, credit interest revenue. Recognition first, money inflow second. Okay, so to kind of get to the end of the lecture here, right? We started with the unadjusted trial balance, that big T account, right, where our total debits equal our total credits. We then did our AJEs, right? Some of those accounts we had to accrue some revenues. Some of those accounts we needed to do expenses, right? So we had some more journal entries that we have to add. We update our general ledger, we update our general journal. Based on these new updated amounts, we can prepare an adjusted trial balance, right? Where our total debits equal our total credits. And that's what this guy is shown over here, right? We had our general journal, right? Where we listed them out, A, B, C, D, right? Every time we did that, we did our general ledger, right? With all the T accounts, right? They would have tentative ending balances on there, which we would use to prepare, right, our unadjusted trial balance. That's great. We make our AJs, right? Some more journal entries. Now we need to update these accounts for our AJs. We're going to have updated ending balances, right? We'll transfer those over along with all the other accounts on there. This will give us, right, we go from our unadjusted, we make our AJEs, to our adjusted trial balance. And again, we'll have all of our assets, our liabilities, our stockholders' equity, our revenues and expenses on here. And when you foot them, they should equal each other. With that, right, we will pause the lecture here because we're at about a half hour. I will see you in lecture 2.